My name is Nate Stuart, and I'm here to introduce you to BNK Shoes of Group G and Industry 2. BNK Shoes is comprised of myself, Mr. Bowie Hand, and Ms. Kathryn Miller, both of whom you will hear from later on in this presentation. I'll start by discussing our company's strategic vision, which is to be the premier provider of high-quality shoes for all types of athletes that value style, comfort, and durability. We believe that our slogan, "The best for the best," perfectly encapsulates this vision and concisely enumerates our values as a company. We aim to use the best materials, provide the best selections, and market our products towards the best athletes. Moving on to the North American wholesale group map for year 11, we can observe that Group C was an outlier. They had the early mover advantage of rapidly expanding their production capacities from the start, while simultaneously implementing a low-cost strategy. On the other hand, Group H experienced an early mover disadvantage. They chose to pair early capacity expansion with a focused differentiation strategy, which set them apart from the pack, but secured almost no market share. Our strategic thought process at the time was to emerge as a quality leader through higher than average SQ ratings and a high number of models. We wanted to secure 10.2% of the wholesale market. It was important for us to have the potential to grow both operating and profit margins. Contrary to Group C and H, we decided that we wanted to start relatively small and expand our operations later on, after the waters had already been tested. Here we see the North American wholesale group map for year 17. And the first thing you'll notice is that most groups were able to separate themselves from the center and branch out into a niche area of the market. Our team comfortably resided in the high quality, high number of models upper corner. We were able to continuously expand our number of available models and simultaneously maintain our high SQ rating. Unfortunately for us, this came at the cost of our market share, which sank to 5.8%. At this point in the game, our thought process was to focus on regaining some of that market share by focusing on North America and to defensively maintain our margins. Group C continued to experience great success from their early mover advantages, and they stayed relatively put in their corner, with low costs from a low number of models, competitive prices that rivaled our own. Moving on to net revenues, we can see that they rose steadily through year 15 before dropping and becoming less predictable. We attribute the initial upward trend with our high differentiation strategy. Starting in year 13, we encountered an issue with overcapacity, as you can see in the graph to the side, where capacity forms a bubble over demand. We were pressured to lower our prices and increase our marketing budget to sustain our market share. There was little we could do to expand our share on the international front, due in part to high expansion costs, such as the constantly changing FX rates in Latin America. In year 16, as a last-ditch effort to save grace, we lowered our SQ rating, which ended up costing us both our market share and our revenue. I will now pass it on to my teammate, Bowie, who will elaborate on other important factors we had to take into consideration.
Thanks, Nate. Hello, my name is Bowie Hand. I'll be going over the EPS, stock price, and the beginnings of the competitor analysis. For EPS, you can see our trend line here very closely matches our revenue trend line, which indicates just how much influence and how big of a primary driver revenue was for our EPS. As mentioned before, our early differentiation gave us a head start in years 11 and years 12. We quickly plateaued and then struggled in the back half of gameplay, year 16 and year 17, to maintain EPS, again, primarily driven through revenue. Our costs stayed relatively flat throughout gameplay. We did utilize some of the facilities upgrades to lower our manufacturing cost. However, those were quickly consumed by the increase in marketing expenses that we had to have as market share became very competitive. Additionally, we looked early on to utilize expansion as a method of reducing costs in our manufacturing facilities. However, industry overcapacity quickly limited our ability to do that as the fight for market share intensified, and the returns for those investments were non-favorable. The third impact here to EPS that we looked at was stock repurchases that we participated in the later half of gameplay. We obviously did this to try and meet investor expectations. However, it did cause some trouble for us in managing other aspects of the game that we'll get into here in the next slide. So overall, our competitive strategy worked well early in gameplay, but as the industry overcapacity really put competitive pressures on market share and pricing, we struggled to maintain performance, both in revenue and EPS here. Okay, stock price. Very much like our revenue and our EPS trends, stock price followed the same pattern. So we had good performance early on, years 11 and years 12, quickly plateaued, and then we struggled in the back half of the year. So in addition to the influences that we had from revenue and EPS, obviously cost as well, the stock buybacks here had a secondary influence in the back half of the year as we began to leverage the company with more debt, and the lack of revenues and earnings to improve our interest earnings ratio really caused our credit rating to drop in the back half of the year, which in turn significantly affected our stock price, as you can see in years 15, 16. The credit rating itself, we were maintaining an A or above throughout entire gameplay until we hit year 16, which we dropped down to a B, and then year 17, which we dropped down to a C+. Okay, competitive analysis. We chose to look at Team A mainly because their strategy very closely matched ours. As you can see in the first two lines of this chart here, the SQ rating and the models available options here. They started year 11 and year 12 without a clear differentiation strategy, which turned out to be challenging for them. As they progressed through the gameplay, they did move the SQ up and become a high SQ provider. In addition, their model availability grew throughout the entire gameplay, but they really differentiated that early on in year 13 with 340 odd models, but eventually grew that to 500 models. And you can see these trends in the right-hand side in those charts. We also looked at their investor expectations in terms of earnings per share, return on equity, stock price, credit rating, and image rating. Again, you can see these trends in the orange lines to the right. The blue highlights here indicate where they met investor expectations, and the rest, obviously, they did not meet investor expectations. So you can see through this chart that through most of the metrics, they struggled to meet investor expectations, which was reflective of the overall results of the gameplay. Similar to us, they did not vary their strategy by region, so they applied the same high SQ, high model availability strategy by region, and they used the same strategy across all the distribution methods, with the exception of the private label offering, which they took advantage of opportunistically. A quick look at a few key metrics for them in terms of revenue, market share, and operating margin. Again, the delayed strategies in year 11 and 12, we believe lost in market share, which is the orange line here, and you can see that declines a few percentage points early on in gameplay. Other companies at this point had already decided on a more definitive strategy, and that, we believe, worked to a disadvantage to Team A here. In terms of revenue, a very similar trend as we had in our approach. Early gains followed quickly by plateau and then challenges in the back half of the game. Again, we believe this was highly dependent on the overcapacity of the industry and challenges in both pricing and market share gains to really grow this revenue stream using this type of business model that both Team A and we used. They had some early struggles with margin, but they were able to improve those really as they implemented their strategy. You can see in year 13, they began to flatline there as they got the models and SQ numbers up. And as they progressed through the rest of gameplay, they were able to improve those margins by offering higher prices as the SQ and the model availability went up. One last piece of analysis for Team A was looking at their capacity and their manufacturing facilities. So this chart shows by year, by region, their manufacturing capability. The orange is North America, the blue is Asia Pacific, and the green is Latin America. And you can see by year 13, they had begun to transition into Latin America and add some manufacturing capacity there. Likewise, in year 16, they completely exited North America and were going to only a 2 manufacturing site location model. We believe that this strategy was an attempt to lower cost and generate more margin by going to that lower cost region in Latin America. However, by only offering 2,750 units in that region, we think that they limited their opportunities in that particular region and did not take full advantage of the cost opportunities there. It is only year 17, so had the gameplay gone on into year 18, 19, and 20, and they continue to expand that, then perhaps this strategy would have worked out to be more beneficial. But as of year 17, we assumed it to be a neutral to disadvantage, slight disadvantage strategy. We kind of solidified this by looking at their performance in Latin America in year 16 and year 17 and noticed that they didn't gain market share. They actually continued to lose market share in that region. Their prices, they were not able to lower prices and maintain margin, which indicates that their cost did not actually improve as much as anticipated through moving to that Latin America location. I will now turn it over to Katie for her to continue the analysis.
Thanks, Bowie. Hello, my name is Kathryn Miller, and I will continue presenting on our strategy to outperform Team A, as well as some lessons learned. Based on our analysis of Group A, had the game continued through year 20, we were able to formulate a strategy to outcompete them in the industry and begin acquiring their market share. Knowing that Group A had pulled their production capacity from North America starting in year 16, we also saw their strategy had stabilized around providing a relatively high quality, highly differentiated product. Thus, our team could take advantage of our production capacity and aggressively target the North America and Asia Pacific regions to gain back market share. We would accomplish this by controlling 3 key metrics: pricing, quality, and model differentiation. Specifically in North America and Asia Pacific, we would aggressively reduce our prices from year 17, creating a highly competitive pricing environment. Our customers would recognize that for just a few dollars more, their shoe quality would jump from 7.2 to 8.2 stars. We could do this without losing our margins by keeping our model offerings at 450 instead of 500. We would have fiercer competition in the Asia Pacific region, but we could look at using some of our excess inventory to acquire sales in the private label sector while we gain more wholesale traction in the region. We could maintain a similar strategy in the internet segment, as we had stronger market positioning going into year 18. Again, in North America and Asia Pacific, we would have the margins to lower our prices and create a similar disruption in the market, offering competitive pricing for higher quality shoes. In this case, we could price at least $4 lower in both these segments, which would help us steal customers from Group A. Our ability to adjust our wholesale pricing positively impacts our internet pricing capabilities and allows us to grow our revenues and market share at a faster rate within the segment. To ensure strategy remains successful, our group must invest in marketing efforts and in securing a long-term contract for celebrity endorsements, especially in the Asia Pacific region. We would look to acquire Nunchuck Norris or Mick Jaggermeister for more celebrity appeal in our focus regions. This slide shows our 3-year calculated projections for both wholesale and internet segments. By running a simulation for year 18, our strategy to target North America and Asia Pacific gave us good indicators that we would gain more revenue and market share over the next few years against Group A. The graphs show both groups' actuals through year 17, as well as the projected revenues from years 18 through 20. You can see that our group's revenue growth would be sourced from a stagnating or declining revenue from Group A. Below, each table shows the calculated projections comparing ending values in year 17 with a conservative 3-year average from years 18 through 20, given our aggressive pricing strategy. In the wholesale region, we would consistently hold our quality margins at 8 star instead of 7, but drop our pricing to more competitively compete with Group A. Although both our revenues would increase the following year, over time, as our pricing became more competitive in North America and Asia Pacific, we would slow their market share growth and take their revenues. Similarly, in Asia Pacific, we would remain consistently lower in pricing for Group A, quickly allowing us to grab more market share and outperform them in this segment. Finally, given the opportunity to analyze our group in comparison with other winning group strategies and the competitive nature of our industry, there were several key takeaways from this experience. Ultimately, had our group been more aggressive earlier in the game, we would have been rewarded with stronger financial gains over time, allowing us to achieve our investor goals. Had we facilitated more capacity growth to other regions and initially taken on more debt leverage, We predict our group would have maintained higher margins while gaining in market share by offering highly differentiated products. The other key learning through this experience is that success in using a high quality, highly differentiated strategy requires investing in significant marketing and celebrity endorsements to support what we're selling to our customers. On behalf of Group G, thank you for joining us for this presentation.